In this video, I'm going to show you a trading strategy that only uses two of ICT's concepts. This strategy is very powerful when used correctly, and it's very easy to apply. So the only two ICT concepts that this strategy utilizes is order blocks and liquidity. That is it. No fair value gaps, no breaker blocks, no SMT. Very simple, just order blocks and liquidity. So firstly, what actually is an order block? So an order block is an area in the market where large institutions, smart money, buy or sell from. We can identify these areas by observing where a large move first originated from. The theory behind order blocks, so this is going to be a bit different to how some like ICT traders view it. However, for this strategy, this is sort of the approach you want to be using when viewing order blocks. So order blocks work because there's not enough liquidity to fulfill these massive orders placed by smart money. Only a certain proportion of their orders may get executed at a price level. This gives informed traders, so you and me, an edge. So what do I mean by this? Say you are a large institution. It doesn't matter who you are, but you're trading with very large capital. I'm talking like hundreds of millions, upwards of more of a billion. Do you know what I mean? So to get these prices, say if they want to buy at this price down here, if they want to buy 500 million worth of euros, for example, there has to be someone selling 500 million worth of euros, because for every buy there has to be a sell, for every sell there also has to be a buy. However, there might not always be enough liquidity, so enough sellers in this area to buy all of your position. So only half of their position may get filled here. So when price comes back down to this level, the rest of the orders will be triggered or they will execute again to defend this level. That's why you see these sort of sharp and large explosive moves of certain order blocks. You can identify a bullish order block by finding the last down close or series of down close before an explosive move higher. So in these examples, and we can identify a bearish order block by looking at the last up close candle or series of up close candles before an explosive move down. Okay, I think most people in the sort of trading world over sort of the supply and demand in ICT know how to identify an order block. Okay, the second concept we're going to be using is liquidity. So a lot of people like to overcomplicate liquidity. However, it's a very sort of black and white subject. So liquidity is simply, it just means money. Okay, liquidity equals money in the form of buy and sell orders. You'll find liquidity at old highs and lows within the market. So what do I mean by that is this is current market price. These are old highs and lows. We'll have liquidity above, below this low, this low, this low, this low, and liquidity above the highs. You also do have liquidity sort of within these ranges, but the liquidity you mainly want to be seeing is sort of external to the range. So sort of these swing lows and swing highs. Smart money knows that these areas are likely places for stop losses and stop orders, buy orders, and stuff like that. So they will use these areas, similarly to an order block, to facilitate the buying or selling of massive positions because they know that there's going to be a counterparty there to take the other side of the transaction. Liquidity, as I just said, is often complicated by some traders and some teachers. You do see this a lot, especially these days. People want to overcomplicate simple stuff, but liquidity in its most basic form is just money. And how is it money? It's just buy and sell orders or stop losses. Okay, so adding them together, how do we add liquidity and order blocks to form a complete trading plan? Using these two concepts, we can form a complete strategy. We can use order blocks with liquidity sat above or below them to find high probability trades that follow trend. That's a big one. It's got to follow the trend. Again, I see a lot of sort of new traders or even some experienced traders who are still unprofitable. They're always trying to catch like these big market reversals. The easiest way to make money in trading is just by following the money. So if the market is going up, align yourself long. The market is obviously bearish. Stop trying to take buys basically on it and stop trying to outsmart the market. I'm a victim to this sometimes. Most of my losses come when I try and outsmart the market. Just follow what order flow is telling you. This works on all time frames, this strategy. However, I found the 1 hour, 30 minute or 15 minute to be best. Specifically, actually the 30 minute. That's probably my favorite time to use this. The reason for that is you have enough conviction on the 30 minute time frame to sort of set and forget. Another reason is because it's not as fast paced. So say if you're someone who doesn't have a lot of the time in a day, you work a job or have children. I mean, there's so many reasons why you don't have time in a day, but you still want to trade. This sort of thing is perfect for someone because you can just check sort of in the morning, in the evening, or just quickly throughout the day. The candles aren't moving at a high speed. It's not like you're trying to trade a 1 minute chart. So it's pretty good. I wouldn't call this a swing strategy. I wouldn't necessarily call it a day trading strategy either. It's sort of that happy in between of not being too fast paced and the trade's not taking forever to play out. However, it's not the 1 minute time frame where you're getting caught out a lot. You have to be quite proactive on the charts. Okay, so again, this is the strategy to draw it in sort of like a easy to see blueprint. An order block, you have liquidity formed below it. In this case, for a bullish order block, this is where you'll be looking for a trade in the bullish order block. So the market comes down, takes the liquidity into the order block, and that's where we see a reaction. Okay, so we're going to jump on the charts now and just have a look over a few sort of live market examples. Okay, so on my screen now, we're on GJ or pound JPY on a 30-minute time frame, and we have a very nice bullish example of what I've just talked about here. So with bias, again, I see a lot of people overcomplicating this. You can do some complicated stuff to get an accurate bias. One of the easiest ways you can get a bias is literally zoom out. If the chart is going up, you're bullish. If the chart is going down, you're bearish. It really doesn't need to be that complicated to get a bias, okay? Especially on the 30-minute. So in this example on my screen here, you can see we had a big push to the upside. We broke structure here. We had a bullish order block. We push up again. What do we have? So we haven't traded back into this order block yet. So these orders here still haven't been mitigated. So they're still resting orders sat. At this order block, we have liquidity just sat above it. What does price do? We trade down, take liquidity into the order block, and that's where we see a reaction. Okay, so in this case, you can just set and forget like I did here. You can see your setup happening here. You might set an order there, target the most recent high. This is a 4.34R trade. With stop losses, I know I'll get asked for this. So the best way, in my opinion, is to find your zone, find the low of it, and just give it a little bit more room than the low. Essentially, if you want to measure it out each time, but I normally just do it by eye, just give it a little bit more room. This will save you from a lot of some like unnecessary losses in a lot of cases. If we scroll back, we can see an example happen. I think this was the day prior. So again, push up, another push up. So we've taken liquidity, like in this example from here. This is our order block. We have liquidity. Let me move this, just sat below it. So this is our order. Let me get my tool back. So we would have hit TP over here as well. Again, if you did have your thing on the your stop loss on the edge of the order block, you may have been all right. I bet probably spreads would have taken you out there. That's why I say just give it a little bit of breathing room like that, and you'll save yourself a lot of unnecessary losses. Okay, so scrolling back, these were just ones I marked up quickly. So again, we have a push up. We didn't tap back into this order block, so it's still resting there. We then have these lows put in. Price trades down, takes the lows into the order block, and we see a bullish reaction. Okay, it's as simple as this. Liquidity plus order block. That's all this is. So on my screen now, this is actually GU at current market price. You can see this has literally just happened today. It's playing out as I speak. So again, we have a push down. Where did the push down originate from? This order block up here. What do we have below this order block? We have Asian liquidity, another high there. So we have lots of liquidity below it. Price comes up, takes the liquidity, trades back into this order block, and we aim for the most recent low. Okay, so again, very simple stuff. Another example here on AU. So price trades down, we break structure over here. The market is generally moving bearish. We come down, create a high. So what's above this high? Liquidity. What do we have above that? An order block. Where do we set our order here? Stop loss, high, target the low. Okay, very simple. Again, liquidity plus order block. So I hope you found this video helpful, and if you are thinking about using the strategy, I send the levels I'm watching every day into my Discord group. Link will be in the description for that. But yeah, this strategy, super easy. I use it myself. It's literally all you need, just liquidity and order block. You don't You don't need more than that. Just get good with those 2 concepts, and you can be paid for life. Okay, so thank you for watching. Subscribe, like, all that. This is my first video, so if you made it this far, thank you very much. But yeah, I'll see you in the next one. Thank you.